We're going to talk about this multifamily deal today, of course, but I'll start off just by analyzing it and explaining how commercial works compared to single family flips. Because this is ultimately what it is. You hear a lot of syndicators and everything referring to their $100 million deal where they're raising capital and they're actually just big flips. Uh, they're all flips. They're 3 to 5 year flips, which you'll say. So really a syndicator often is just a big flipper as well. Um, it's just a little different on how they analyze the deals with multifamily and so forth. I will talk about that here in a second. It's very interesting to me just how to analyze multifamilies and structure them and so forth. Um, we've been flipping now for 10 years and extremely good at it and love flipping. And our team is really good at design work and at the projects we've done. We've done some really hard projects, to say the least. Some projects people can't believe, oh, you got to tear it down, or what do you can't do that project. And early on, I took on some really hard projects, just to almost up my level of comfort. We weren't doing as much, so when I did early on, when we were doing 1 or 2 projects at a time, we can do some really hard projects. And when you do a house that's 14 support beams underneath it, and we're jacking up the house with car jacks and crawling on there and changing out really hard stuff, it makes anything else seem easy after. And you'll see here in a second, this multifamily project, it's kind of it looks like that, where it's like, oh man, this thing needs to be turned down and it's really bad. But when you've done some 10 times harder project, it's just like, it's cake. So it almost like you push your comfort levels to get comfortable at, in projects. I do have a construction background as well, so I do have comfort in construction. But yeah, through the years of pushing some really tough projects gives us that comfort level to try bigger and harder projects. We did this huge house in Manoa one time, and it was kind of falling off the hill, and we're dealing with foundations and supports, and it was really a hard home. And when you do those homes and you get it and sell it, of course, and you get through that process, you just get this feeling of like, oh man, the next one's even easier. And that's kind of where we're leading at today. This multifamily deal, I've been looking at multifamily. We own a bunch of multifamilies in the US, across the US. We own the shopping center we just bought, and we own an 11 unit. We have another 8 unit. So multifamily, we've been accustomed with and dealing with, but just here in Hawaii, it's really hard to find a good multifamily deal. Often here in Hawaii, multifamily is a great place. A lot of foreigners, Japanese, Chinese, foreign money generally want to just park their money. And that's why our multifamily is so expensive or hard to get good deals on, because Japanese want to take their money out of Japan and park it here in Hawaii and buy some small multifamily and just let that thing appreciate, because that's what we have here in Hawaii. Our multifamily stuff just go up in value just dramatically. The appreciation is crazy. So it's a great place for them to park their money. So you often will see a lot of multifamily buildings, some even abandoned, and they're just parking their money in it to let it appreciate it. So it's a really tough multifamily market here in Hawaii, because of it's just so far and few deals. There's probably 10 deals on the market at a time, and the competition is very fierce in that you're dealing with cash buyers. You're dealing with people who buy these things in cash and they don't care. They'll buy it at market because they're not caring about often the asset. They're caring more about the parking their money, getting some cash flow as well, but parking their money. It's a huge thing. And that's why we'll go into today, we'll talk about cap rates, but we have a really low, probably one of the lowest cap rates in the nation. Our average cap rate here in Hawaii is like 3.5%, 4%. Most things are selling right now at
That's
three
really
and a half.
good.
Oh, Tony's. So we have some really low cap rates. And with that said, with low cap rates, meaning low cash flows. So often these multifamilies here in Hawaii, we you can't get good bank loans. The loans will be like 50% loan to value. The reason the bank and lenders are giving you so low loan to values is because the cash flow is very weak on these things. Because again, they're just parking their money here. So generally, our cap rate, and we'll go over that here, is 3 to 4%. We'll talk about that later. Our cap rate is your comps. So multifamily, they use cap rates as comparables instead of in a single family world where we use comparables like for like houses. In multifamily world, they use cap rates. And we'll talk about that here. But let's kind of dive on into it. I have a little slideshow here that will go through this particular deal. And then we'll also talk about how to analyze multifamily. I think multifamily is pretty interesting to analyze and understand. And then we'll talk about the different opportunities we have with this particular project. Let me start sharing my screen. Country and numbers of multifamily. We'll just do it this way. I kind of gave a quick about us kind of synopsis. We've been flipping now for 2013. We started flipping, done about 120. I think we're around 130 flips about at this point. About 30 flips a year we do on average, buys and sells. Last year we had a great year. Our investors, we pay 12% return, and we paid out about $324,000 to just our private investors alone, which is huge. Without our investors and capital, we're not able to do this kind of volume and make great returns. This year now we've structured some deals differently, and we'll talk about that here in a second, where we're giving away as well tax savings on certain deals, and just to make it a great win-win. And we'll talk about tax savings here in a second. I can talk about that all day long if you want. So we've been doing this for a while, and we love doing it. We've done some multifamilies. We own a commercial shopping center in Janesville, Wisconsin. We own 160 doors at this point of rentals, and I think we have 16 flips going at this time. Now there's 6 across the US. No. Oh, we just closed on another one. It's hard to keep up sometimes. We do a lot. I think we sold something today in Ohio, but we have a bunch of flips across the US going as well. And then our Hawaii ones we have going as well. So this is a quick synopsis of basically how we analyze deals. We have these deal analyzers for everything we do. We have a deal analyzer for fix and flip. We have one for our Airbnbs. We have 6 Airbnbs, and we have one, of course, for multifamily. On this particular deal, I actually combined 2 deal analyzers. I'm an Excel junkie. I love Excel. I'm very big into numbers, electrical engineering degree. I love Excel. I love numbers. And I developed these deal analyzers. So this is our particular deal analyzer for this deal, treating it as a flip. We can come back to this in a second. It's kind of, I think, switch around. So this particular deal is 2 complexes. We're buying these 2 buildings right here. There's this building and then this building. They're 2 different buildings. We have videos and pictures if you want to see later. This particular building is actually a really easy flip, or great building. It's because it's a CMU building. You can see it's all cement building. So the rehab on this is pretty easy. We're just painting this. And another huge part of this building is, see this cement line through this whole thing? That's our floor. The whole cement between the 2 floors is all cement. So meaning that this thing is just a solid brick house, literally a solid CMU brick house. This building is just solid. So coming through here, this rehab in general is pretty self-explanatory. It's pretty simple. we're coming through here and we're changing out windows, of course, and then inside the units is where we'll gut it and change. And these particular house units are really great opportunity. You can actually, this is literally 500 yards to University of Hawaii. So the all around here, you can see this tall building is all student dorms. If you know where UH is, and behind Sherwood-Williams, there's that old health food store that's down the way from on University and King Street. There's that other kind of, not down to earth, there's that other health food store. It's right behind those buildings. So a lot of these areas is all for student dorms and student housing. So it's a great opportunity for rentals in this area. And I just been doing a ton of research on the area. Also across the street on Kapiolani, the Kobayashi group just bought a bunch of buildings, and they're tearing them down. They're getting rid of about 1,200 rentals. So those 1,200 rentals, they're also going to need a place to stay. We have to keep that in mind because our end goal on these projects are not just to fix and flip, but to rent it out. So this project, these two buildings, yes, we'll make them nice and we'll make them new and do our magic, but our end goal is actually to get them rented out. And that's how these multifamily works. Multifamily is valued based upon income. It's based upon its well, I'll show you right here. Actually, we have it. I have it open here. I'm just going to show you my straight deal analyzer. So this is our deal analyzer we use. I think you can see this. So multifamily is based upon two things. It's based upon your income and your expenses. And our biggest thing on this multifamily deal is our income. And there's no income right now. It's not rented out. So we have to figure out what these 2 bedrooms would all rent out for. So these are all 2-bedroom units, and what will they rent out for? So we do a lot of research. We first look at the median income for the area and any market I'm in. Obviously, I know Hawaii very well. Look at what other things rent for, what people can afford. A huge thing we look at is Section 8. Section 8 will dictate what that area they will rent out for. So Section 8 is a great kind of cheat code sometimes to use. In some cities across the US, they actually are very high. Here in Hawaii, Section 8 is pretty comparable with what rents can get. And anyone here in Hawaii know that this is a 2-bedroom, 2,200 in town is pretty comparable of what a 2-bedroom can get for. These will be brand new, obviously fully gutted, everything brand new. So 2,200 is very comparable to what we can get for to rent these things out. So that's going to be our income. And our income, we just take the 2,200 and multiply it by 14 units total and times it by 12. We have 12 months in a year. So annual income for this property is about 370,000. That's conservatively at 2,200. I honestly think they can probably be rented for 2,300 to 2,400 a month, but I'd rather stick on the low end side of the numbers, of course, and kind of keep conservative. We always keep conservative. So you'll see some numbers on here that are probably a lower or above what normality is, but I just been doing it for 10 years, guys, and I like to be conservative. That's how we last so long. So you'll see some numbers on here. We're always trying to under project and over deliver, of course. So we always want to be safe. So this thing produces about 370,000 a month. We do take into account, of course, for vacancies, 5% for vacancies. So this gives us our NOI. This is our net, our income. I'm getting ahead of myself here. Then we go on to our expenses. These units have General expenses, most of the expenses are given to the tenants. The tenants are the ones paying for their own electricity and as well as their own water and gas. Um, there's already sub-metered for water, which is huge. Already sub-metered for electricity, of course. So every renter will have their own meters for electricity. So the renters are paying for electricity. One expense gone down. Other expense, water, big expense, right? There is 6 sub-meters in the street. The silver copper, those big panels in the street. So they're already sub-metered for water as well. So another expense, bam, gone to the tenant. And then the other unit has gas as well. And there's 8 gas meters as well. So bam, another expense gone, given to the tenant. So us getting rid of those expenses is huge because we are looking at income and expenses. And again, we evaluate this property based upon our income and expenses. In flipping, we add value by making a new flooring, new roof, new material kind of item. That's how we add value in a single family world. In the commercial world, value is not portrayed on, if you do a new unit, you make it all nice, that's fine. It doesn't add value until you can get a renter in there and you have expenses. They look at the value based upon the income of the property. So in any commercial type of deal, from storage, single family to commercial, it's all based upon this total NOI. So our expenses for this building, kind of high. Gas and electricity, I don't think it's $2,000, but a month, I just want to be safe. Of course, we have insurances. We got some quotes right now. We're still working on the final insurance number. We do got to pay insurance and we do got to pay taxes. This is the exact tax number that we'll be paying for property tax. We have an 8% management fee just to have on there. We probably will self-manage it off the start. Of course, because we self-manage our own stuff, but we could take that out. But we want to project this, what it would be worth for somebody else. Repairs and maintenance, everything is going to be brand new. So everything is going to be new. And so it shouldn't be, repairs and maintenance. But again, you just want to be safe and have these kind of things covered for. And then sewer and water. I think this is still high because when I first analyzed this deal, I didn't realize water was taken off. So water will be taken off. We don't have solid numbers yet on these because no one's living here. It's not being used. So we're just trying to be safe and analyze this. And then any kind of deposits or reserve replacement, we just have kind of a safety net of numbers. So we have about 81,000 of expenses. So this is a big thing. It gives us our total expenses, 81, and then you minus that from your income of 369, and that gives you our NOI. So our NOI is everything. That's everything. Our NOI is about 270 a year. This is annually, and you take that NOI and you can divide it by what your cap rate is of the area. So your NOI and your cap rates are how you analyze a deal. Cap rate is what we use in commercial, in the multifamily world, and cap rate is really just, think of it comparables. It's like what do other properties cap rates do they sell for? So instead of getting 3 like for like buildings and doing it like a single family type of deal, you use a cap rate as what that city or that neighborhood is commonly selling for, what that cap rate is for. So we use cap rates more in the commercial world, and you don't lean too much heavily on the cap rate. It's just an average normally. We will get appraisal. They already just went, and they will look at some of the other buildings, and we will analyze it both ways. But generally commercial, we're going to use a cap rate. And again, I'm being conservative. Most stuff we just got a list of everything that sold. They all sold at about 3.5 was the average cap rates that just sold. But I want to be conservative and say 4% is a good deal. So that little bit of a change in cap rates is like an 800,000 change. So just by changing that cap rate, just that little bit will dictate the final value. So we're anticipating at a 4 cap that was just shy of 7 million. So at a 3.5 cap, at 7.8 million. And again, this is really important number to kind of understand. But this is our deal analyzer, and these are how we're analyzing the deal. Other things we look at, you want to know at a 7% interest rate, what's your NOI income on this thing? Thinking about 100 grand a year and so forth. We want to know that because there's a possibility that we would keep this deal, maybe keep one of the buildings, but refinance out and sell it. But I think we're committed to selling these properties. I think they'd be better off. Bring the presentation back. I think they'd be better off to be sold, and we'll probably buy some mainland properties. So this is how we analyze that. So that's how we got that 7 million right here. Our rehab estimate is at $1 million. I don't have the budget up here, but I have a full breakdown of the budget. Our contractor, our sub, he came in at 750,000 for the rehab of the property. He's done a bunch of projects for us. He does great work. He's quick and easy. These rehabs of these properties are they're pretty easy compared to nice. I think Tony's on here. His, a $3 million house. You're going to be a lot more detailed oriented. These rehabs are just quick and dirty. You're in and out, basic, new, clean, nice cabs, flooring, simple kinds of rehabs. You're doing the same thing across the board. We'll have the same flooring in all the units. We'll have the same everything, throughout the whole thing. So one, we can buy in bulk, we can keep the cost down. And two, these are just low income housing technically. These are affordable housing for people. So we can really pound these out quickly. The guys will be actually, you can see the two buildings here. Then it does look a little scary outside because of these steps make it look scary, but these are just steps. These are steps. You tear them down, you build them back. They're not bad at all. You can tell these buildings are CMU and these are siding. We do these all the time. I wish I can show you how pretty simple it is. You basically will take new siding and you'll nail it into this side, and then inside of this we'll frame it. We'll put 2x3s, basically straight up and down 2x3s, and then drywall against it. So you're encapsulating this whole structure. Of course, tent the building, kill termites and all that stuff, but it's not too hard at all. It's really, really straightforward. And inside of all these units, they're really nice. I wish I could show you a little more pictures, but inside the units are really, really nice. They're this old school drywall with chicken wire basically in it. They used to do back in the day. So they're really, really sturdy buildings. Believe it or not. The roof, yes, of course, we'll redo the roof. The flat roof, super easy to do a flat roof. Very simple, straightforward. Flat roofs are probably the easiest thing. But with that said, we have a budget of 750,000 from our contractor, and then on top of that, I am adding in about 250,000 for miscellaneous, some landscaping, of course, and appliances. I just want to be safe, and we'll have some other things that he's not doing from his contractor. We have to bring power into the unit. We'll probably pave this and make some parking stalls. So more of the outside stuff, the building. So we have another 250,000 of it that dedicated to outside the units. So we want to cover for any of those contingencies, and that's why we rounded up to $1 million in our budget. And that's how we get it. So a contractor gave us a quote for 750,000 for everything, materials, everything included in his budget. And on top of that, again, we cover appliances, appliances, any fancy fixtures we'll cover. We kind of work back and forth with him on fixtures. Some of it is covered by him. Some of the more fancy stuff is covered by us. We do a couple things that we want popping, a nice faucet, some nice lights, even some of the fans and the shower head fixtures. We want those things to kind of pop and stand out. It gives a little bit of extra to the unit, even though it is low income. If you guys see my work, we really are proud of our work, and our quality of work is really important to us, and so forth. So that covers the rehab kind of it all. This is how we potentially look at it as a flip. So we'll look at the ARV. What can we sell this properties for? 7 million. What's our rehab? 1 million. What's our purchase price? It's 3.1 million. We anticipate a 6 to 9 month rehab is what my contractor tells me 6 months, but I want to be safe and say 9 months. Of course, things may happen. We've already actually applied for our permits, so we actually started our permits. It is a huge dilemma and drama, or whatever you want to say right now. Of course, we have 6, 7 permits going on right now with the city and county, and if it's a big issue here in Hawaii. They're really delaying it. Good thing in commercial is they allow you to start work if you have your permit happening. So a little different than single family. Commercial, you can apply for a variance to actually start work. So they do allow you to start work legally with the commercial side. So that's why one reason we applied already. We got the ball rolling about 3 weeks now, 2 or 3 weeks now. And come August, they're actually changing the code. So we want to get in before they change some of the requirements. So yeah, the project itself, a huge part of it all. This is where we have to raise. We have to raise about $1.5 million for our investors. We raise, of course, down payments, carrying cost. We raise money for construction rehab draws as we go, and we raise enough to carry and float this whole project. I've learned the hard way, where I've just raised enough just to purchase that property, and I didn't raise enough to carry. We have mortgages, we have a big thing, construction draws. So we'll get draws from our hard money lender, but we won't get that until we do work. So often we'll be fronting, 100,000 probably on this project before we even can get a draw. So we raise for that as well. The profits and all this kind of deals really depends. And she was just asking me about profits right now. We look at our profit and our projections on these types of deals as a safety net, in case if you go over budget, you can't sell, you want to be able to carry. So you really want to have some good big profits on these types of deals to potentially carry, a long-term type of project. And that's why we really love this project, because we can potentially carry this longer if it doesn't sell. So the process of this flip is to buy it, of course, fix it up, really add value to it, permit it, get it legal. And at that same time as permits are closing, we're also renting out. We'll probably start renting out sooner. Compared to a fix and flip where we fix it up and we sell it, these ones, again, we have to rent them out. So that little bit of extra time, another 2 months of renting it out, is also required on this particular project. And we'll start that process even ahead of time. We'll do some creative things to rent it out, like we'll do half deposits required. We'll lower deposit. So say, our rent's $2,200. Normally you'd have to bring $4,400 to the table, which is a lot for somebody, $4,400 just to rent a unit. We'll lower that down to, bring $3,000 to the table, and we'll rent out the unit. And that way we can get them in there, and we're basically selling these off. So we'll do little things to help get people in there, give them incentives to move in. Maybe give them the first month rent free or something like that to bring them in to the unit, because once we're about 80%, 90% occupied, we're bringing it to the market. And we'll probably keep one unit open just as a show unit, and we'll bring it to the market then. The other huge part, I kind of didn't touch into it, but these two buildings right here is opportunity zoned. We're not going to do it, but I've already been approached by another huge builder, and you can build up to 39 units up. So we could tear this down with no parking required, and you can build literally to the end of this community, to the boundaries, and we can build 39 units straight up, just like this building right behind us, right here. So we could copy this building and build it right here, but it's a little big of a project to me. I'm more of a fix and flipper, so I'm going to stick to my expertise and continue what we do best. But the opportunity zone builders have been definitely approaching us for this, because there's not too many opportunities zone buildings. And right now the state is allowing opportunity zone buildings to be built out. You can actually see right here is our sub water panels right there. You can see all the 6 water meters. But this particular project is just straightforward for us. It's a fix and flip to its simplicity, and we're renting it out and we're selling it. Anticipate that to be a 12-month to 18-month turnaround. Realistically, it could be up to 18 months, but the goal is to be 12 months turnaround. We're quick. We're trying to be always quick. To us, quicker the better. I have a full-time project manager who will be basically hounding our construction guys, project manager, to push them to get things done, where they're at with their schedule, timelines, what kind of delays, so we are trying to turn as quickly as possible. The only delays for us right now is permits, of course. That's our biggest struggle on these kind of things, is the permits. So we're buying with a hard money investor. They're gonna fund 70% of ish, give or take. They're based upon appraisal. So once the appraisal comes back to them, they'll tell us exactly how much they'll fund, and then we need to raise the rest to fund this whole particular deal, and do it as a flip. It's a big flip, but to the multifamily guys, this kind of stuff scares people, these kind of buildings. But to me as a flipper, I'm like, this is cake to us. Especially when I've done some projects way harder than these. It's just showing you looking scared, because this is just a step falling down, but it's not that bad at all. For anyone in construction, you get in there and you see it's not too bad at all. The harder stuff is actually paving this. We're going to pave and do all the landscaping and all that kind of stuff. But yeah, it's a great full-scale type of project, and we're excited for the community that we're going to bring a lot of housing to the community, a lot of student dorms potentially that we'll be bringing to the community. We're excited to just be able to do this type of project and turn it around. It's been sitting for 20 years, guys. This one building haven't 20 years haven't been in these units. Some of them, there's got old Crawford tubs in there, and really old comics and stuff like that from 1996. I've seen some comics in there, comic books. So they're just been sitting for a long time vacant and looking for somebody to come in. It's been held by 3 generations, and they just kept on getting passed down, and we are buying it straight from a trust, a Japanese trust, and they just obviously don't have the money to do this type of project. But we see the value in them, and we're really excited about doing them, and like to turn this thing around quickly as we can. That's our goal, as quickly as we can. We have everything already rolling from our contractors already ordering stuff and getting moving. We haven't even bought the thing, and he's already kind of ready to roll. Started the permits because we want that to roll faster. My project manager's been there and he's getting his game planned up. And of course, I'm there with him, just figuring out, so day one, we're hitting the road and we're running, we're moving. Because the quicker I can turn it, the quicker we can get our investors' monies back. And I like to be quick. I like to get our investors' money back as quickly as we humanly possibly can. And then we do more projects. So quicker we can do one, we can start to the next project, of course. Yeah, I think I covered everything. So we're looking to raise about $1.4 million, $1.5 million for this project, and should be 10 to 24 months. Really hard to say. The hardest part sometimes to say with these is our two permits and as well as the sale of the properties. These things, we would get into escrow and sell these. They could take up to 6 months sometimes to sell multifamily. So multifamily is not a simple, easy close like single family. So say we're done in a year, it could be another 6 months to complete the sale of it. And it's just multifamily is just a longer process. We've been buying this now for we'll be in 3 months by the time we close this thing. It's just how multifamily works. So we do we're looking to raise the help purchaser right now. We do a 12% return for investors, but we also do have tax credits and tax savings we do. So anyone who does real estate professionally is a great candidate for this. If not, you can get the tax savings through our cost segregation that we'll do. But it's on a person by person basis, basically. And I can speak to you directly about that and how we do structure that. We just did that for our Janesville property, where we not most of our investors, about I think 6 of our investors, five investors I think took tax savings, and that's for anyone who needs to wipe out their taxes as well as get a return on their money. So on that particular deal, we did 8% to our investors, and then they're getting a dollar for dollar tax savings. We had a few people who had high income, and a couple of people invested $300,000 or $500,000, and we were able to give back $500,000 in tax savings, so you can offset your natural income, your normal income, and the savings you're really making is huge, because now you're not paying 30, 40%, 37% on taxes. You're saving 37% on taxes, and you're getting that money back compared to spending that money on expenses. But we can, if you have questions, I can dive in more on that if you guys are interested in hearing more of that. If not, we just normally do a 12% return, quick turnaround, and so forth. The tax savings ones is a little more complicated, I guess, for certain people. But yeah, we do a quick turnaround, 12% return. So however long timeline the funds are invested up with us, from the day you wire to the day of the sale of the property, then that's the time the funds are with us at White Sands Capital is our investment fund, is how long the time it's with us. So it's a 12% preferred rate of return. Yeah, let me kind of exit. I think I want, yeah. So that's the main two things. So that's the main two things. It's a flip, but a multifamily flip. It's a quick flip in the multifamily world, and we're going to sell these two off. And we'll look at, our buying agent, Neil, he's already looking at trying to sell them off. In the multifamily world, there's like this little secret I don't want to secret society. It's a very small community of buyers and sellers. They all know each other. And that's why we're trying to grow that little network of people. So we know a bunch of them right now, and they all sell these deals to each other before they even hit the markets, a lot of them. So that's what we're going to already try to do ourselves, is to kind of get these units not looking so bad, and then we're going to start talking to our potential I don't want to say competitors, but other multifamily world guys out there, and sell these deals before they get into the market, of course. And then if not, we'll put it on the market. In the multifamily world, in the commercial agents, a lot of the agents will sell to each other first. The deals will hit each other before they get on. Then they'll get onto Crexy or LoopNet, and then they'll get onto MLS. So it's almost like a lot of the deals are sold before people even see them come on. It's just a small community in the commercial world, and days on the market are pretty low. Most of these days on the market are under 30 days. Especially for this area, this is hard. This is Kapi'olani. This is university. So this is like the creme de la creme of multifamily world, where most of the investors want to get rid of their Waipahus or their Aias, and they just want to be in town because appreciation. They want to be by universities, because they can come in. Peter Savio, for example, will come in and he'll take the same unit, probably split it up and put two kids in each unit, charge them $1,000 a piece, and have 4 kids in these units. Peter's a great example of doing that kind of stuff. And again, that's just increasing the values by adding the more income to it. And it's an opportunity. We could try to do that well, but I just want to be conservative and keep safe numbers. But that's the gist of it all. It's a great location, obviously by university, and it's a great asset to be owning. I mean, everyone tells me I should keep at least the brick building, the CMU building, refinance out and keep that one CMU building, because it's a great asset. But we are comfortable buying in the US. So we buy multis in the US that are a little better cash flow across the US. Again, we'll probably be selling these to a Japanese or Chinese buyer who just wants to park their money, or a big investor who just wants to park their money. They're all right with a 4% cap rate, which is a low cap rate compared to when I'm buying in the mainland, like we bought a 12 cap, which is better. The higher cap rate, the better of a buy. But yeah, this is commercial. It's a little different than single family, but it's the same principles. We fix it, make it nice, and we sell it. It's the very same principles. We buy low, sell for more. Buying it for 3.1 mil, put in $1 million into rehab it, and we'll sell it at 7 million. And we have enough cushion of profit in there to overcome any hurdles or obstacles that we may see. I don't know, some plumbing breaks and we have to dig out the ground and spend 10 grand, there. Or in the flipping world, anything and everything will happen, and it's happened to us. So we are always ready for those types of things, to get past those things. And that's just part of the deal with flipping. You just never know what you're gonna come into, but we've seen a lot and we've done a lot, so I think we can get through any of that. The construction side doesn't scare us. It's not a huge thing like most people would be scared of this particular project. But yeah, we have a 12% return for all the investors. I forgot to introduce Kylan at the start. My bad. Kylan.
You're good.
Kylan is
Yeah,
go ahead. You want to go ahead?
yeah. My name's Kai. Obviously, I work with this guy right here. Yeah, I handle most of the investor relations, deal acquisition. So, if you guys have any questions about this deal at all, please contact me. Shoot me your number or your email in the messages below, and I'll get in contact with you guys. A couple things about this deal. So I've talked to tons and tons of people about it, and some people fear the multifamily aspect because it doesn't look, just like a simple single family fix and flip. But I don't want you guys to get hung up on that. I mean, this deal really is simple. I think Indar laid it out very well to where it is just, it's just a giant, picture it as like a giant single family essentially that we're going in and rehabbing, and we're just going to do the exact same thing that we always do. So yeah, I mean, reach out to me. I know there's a few familiar faces in here. I apologize if I've bugged you guys and blown up your phone. I take follow-up very seriously. So if it's ever too much, just shoot me a text. Kai, shut up. That'll get it done. Or Kai, I'm ready to go. Either one will work for me. So yeah, I mean, like Indar said, we got to be quick on this deal. We'd love to have some new investors on this as well, since it is such a solid deal. Indar's been in the game for 10 years. We'd love to bring on some more, future long-term investors that can, trust us to park their money, grow it, save them on taxes in the end, and, essentially replace your savings account that's saving you, 3% or 4% every year. We're giving you 12. So, it's an excellent deal. I'd be happy to connect with you guys. Even if this isn't the deal for you, I'd love to build a relationship. So, thank you guys for being on here, and I'm excited to get to know you guys.
Yeah, Kylan did a great job. Kylan helped lock this thing up at the beginning, actually. And I didn't think we are going to even get this deal. We threw our crazy offer out there often as we do. And they said no. They went with somebody else. And that guy was trying to get a traditional bank loan. Like, you cannot get a loan on this. Banks want to lend on something livable and safe, and there's no way you can get a traditional bank loan. So we got the project and we're like, oh, we got hard money all day long. Hard money's, they will lend on the project. So of course we have a hard money lender that comes in there. They vet the deal. They make sure this deal's a solid deal. They don't really care about us. They care about the deal, the asset. And we get these loans from hard money lenders. They're sending appraisals, or they're checking their own rehab budgets. They're making sure ARVs, what we can sell these things for. So the hard money lender almost gives you like this big safety net of, hey, he verified the deal, and they're making sure the deal is a deal, because ultimately they're funding majority of the deal. They have a couple million at stake, so they're going to make sure the deal's a deal as well. So we came in with our trusted hard money lender that loves the deal, of course, and now they're just running appraisals and so forth and making sure they love the deal. And so that's another kind of safety security, is that the hard money lender is not going to lend on this deal if a deal is not a deal, and so forth. But yeah, I can talk some more about the tax savings.
Indar, well, I got a question for you that I get often. I think it'd be beneficial for everyone to hear. One of the main questions that I get when we're speaking with new investors is, how do I know that my money is secure?
Oh yeah, we didn't talk about that. Yeah, so we do a promissory note and a mortgage. So you're not just investing like with me and Kylan, you're investing on the property. Promissory note talks about your interest rate. The note, it's a note. It's talking about the return and so forth. It's talking about the numbers, money. But more importantly, we do a mortgage. Some other investors don't do a mortgage. We do a mortgage. And the mortgage attaches you to the property. So you're leaned against the property. A great example is when you have a car, you have a loan or lien against your car. When you go to sell your car, have to pay off that lien first. So the same thing applies in our fix and flip world. We have a note secures you with the amount, but the mortgage attaches you to the property. So when we go and sell the property, we have to pay off our mortgages. So all our investors have a mortgage attached to that property. So you're investing secured against the asset. You're not secured by me. We can do anything else. We do personal guarantee, whatever you need. But biggest thing is you're secured by the asset, the property. And we buy these so well below market value that there's a lot of room in the property with a ton of equity, of course. But that's a huge thing, of course. And we get it notarized and we have it all recorded and down at Bureau of Conveyance and so forth. And it's the same set of documents we've been using for a while. And I had a real estate lawyer invest with us one time, and he pass the documents. So they're pretty simple. But biggest thing is that, and this is not, we're not all in on this one project. You know, we have 15 other flips going. So this is not, you know, a make it or break it kind of deal for us. So our security is the sense that we're not small, we're largest in Hawaii. You know, we're not make it or break it on this one deal, you know. So we have the security or comfort zones that we have other projects going, which helps with a lot, you know, helps me to hire a full-time project manager, helps us to have spread out the risk factor of all our company, you know. So being a large company helps make these projects feel more safe and secure. It can explain a lot more than you realize. Actually, being a large company, having this team involved helps making these projects really be more secure. Taxes. Having it here, so the total time is 10 to 24 months. We're saying 24 months the longest. The two biggest things is time. Is one, permits. So the permit process could delay us, could hurt us. So that's the one thing we can't control. There's protests, there's all kinds of drama going on with the permits. So that could delay us to close and sell this thing. We need to have permits. There's some workarounds with that that we've been trying to do. I have different routers, I have different permitting people, I have so much different people I've been trying. I have an ex-inspector helping me pull permits. But there's nothing that right now that really can really help. You just gotta wait. So that can help, that could delay us. To rent it out as well, you're technically supposed to have a certificate of occupancy to rent it out. So that's going to be a little tricky on if we don't have the permits that way. So that's our one concern. And then other concern is selling, you know, of course, selling, you know, it's not a crazy hot market, you know, right now. Obviously things can take longer to sell. So the selling could be 12 months or can be 24 months. You know, it's just it's hard to say with selling. That's the one thing I can't control. I can control the rehab. We're on it. We're down to our timeline. Our guys are moving. We're done. You know, we rent it out right away, but then it can sit on the market for months and months. And you just you don't know. So selling is definitely a hard thing to, you know, give a time on. You know, we've had a project went through 5 different escrows, 5 escrows of falling in and out, and I just, you know, you can't account for that. So 5 escrow, meaning, you know, 2 months of going through escrows and going in and out of escrows. So that could be a huge thing that we can have these sold or in escrow for 3 months and it falls out. You know, they can't get their financing or they can't. And then
So what do you think?
we got to do another
What do
3
you
months.
think?
Oh, Kevin, sorry. See you. Do you have a question? Oh, but yeah, that selling is our other kind of factor that is we can't control. So that's why we say 12 to 24 months, but ideally we'll be out of it in 12 months, you know, probably around 18 months could be, but we just want to have that expectation that it might not be right there.
I think everybody would probably like to hear a bit more about the tax savings as well.
Yeah,
Indoor
questions. So with the tax savings, normally somebody, let's just use examples. Normally invest somebody with 100 grand with us. They'll get a 12% return on that 12 grand. So we take that 12 grand, multiply it by 12%, divided by the time with us. So however long we carry that money, that's a normal. It's called a preferred rate of return. It's how banks, it's how all interest is normally done. With the taxes, I've been kind of backstory. I've been flipping houses for a while now, and flipping is a great income, but in a flip, we have to pay probably the largest tax bracket. We pay capital gains. Capital gains are huge. When you sell a property within a year, it's a huge tax bracket, a huge tax cost. A lot of flippers don't talk about it. The gurus don't discuss, because when you sell a property, it's a huge tax burden. So 2019, we started kind of doing well and basically learned about the cost segregation study. We were flipping. We started buying rental properties, not just for the cash flow. Yeah, it's cash flow, but my real idea to buy rental properties was for the tax credits, the tax depreciation. So even on single family houses, you can do what's called a cost segregation. The best way to explain a cost segregation is it's called depreciation. So we'll use your car. Your car, you buy a brand new car, it depreciates. It goes down in value over 5 years. So you have a car and it's depreciating in value over 5 years. It just deteriorates. Natural decay. The wheels get old, the engine it decays over 5 years. So you can take that value of your car and you can divide it by 5, and you can take depreciation every 5 years for that car. And 2017 came along and they did accelerated depreciation. And what that is tax bill 178. And you can accelerate that depreciation to year 1. So that whole car you bought, the great example, I did this for my wife. She bought her a $75,000 car because we had a great year. And instead of taking that over 5 years, we took that year 1. So we took $75,000 depreciation off our taxes. With real estate, it's even better. Same idea. They say a single family house will deteriorate over 27.5 years. So you take that value of your house minus the land doesn't deteriorate. House divided by 27.5 years. Commercial, it's a little different at 39 years. You just divide it by that number, and you can take that depreciation every year. And that's called straight line depreciation. Very common. Most accountants will know about straight line depreciation. You'll ask an accountant, they'll say, "Oh, I know about that." But 2017 came and we got accelerated depreciation. So now we can take the value of that house and push it all to year 1, and as well as stairs, roofs, doors, windows all deteriorate. Your floors get old, your roof gets old. So they all have a deterioration, 7 years for some, 5 years for others. We have an engineer that comes and looks and gives you that values. And they give you that values over 3 years, 5 years, 7 years. And all of that gets accelerated to year 1. So we just bought Janesville Shopping Center for 6.6 million, 5.8 million. We can take that shopping center and do a cost segregation study, look at the depreciation, and we can do that study and get our depreciation and apply it year 1. The con is now we can't use it next year. We're using it all now this year. Another con is to be able to use it, you have to do professional real estate full-time. Great for escrows, agents, real estate agents, investors, people who own rentals. A great strategy my friend does is he goes after doctors and he gets the wife to become a real estate agent. And then that doctor can now use the depreciation because the wife does real estate professionally. You got to be particular on this because you just want to cover your butt. So if you do real estate full-time, super easy, great for agents. So I have a bunch of agents who invest with us for this same reason, because we are great at finding these great assets. We're great at finding these great flips, because we can now give this depreciation off to our investors. And the way we do that is a little differently. We do an ownership. So if you own the property, you can get depreciation. So we'll do a 1% ownership to the property. And now we can dictate on the operating agreement how much depreciation you get. So we do a dollar for dollar depreciation. So we'll buy this big property. We'll get Janesville property. We got about 2 million in depreciation. We can take that 2 million and we can apply it to everybody in that deal, whoever deemed to want to get the depreciation. And we do that with a K1. if you own any properties, you're probably familiar with a K1. A K1 is for rental properties you get from your accountant. So our accountant, again, I'm just explaining this, accountant really does all the work for us. So investors come in, they invest 100 grand with us. We give them 100 grand in depreciation that they can come and apply on their personal taxes, on any kind of tax income you get to use against your taxable income. There's two different kinds of income. There's your W-2 income and your I can't even think of the word right now. You can apply against all your different types of income, basically, if you're a real estate professional. And then you let us fix a property, and we're able to then fix it and sell it and obviously get your money right back. Compared to, say, you make $1 million and you're trying to lower your taxable income with expenses. You lower your income, but now you look horrible on paper. Another shitty thing about expenses, cost money. You don't get that money back. You go buy a new computer, you don't get that money back. And you don't look good on paper if you're trying to get loans. When the old school way, you're trying to lower your expenses, you're trying to zero out and look horrible on paper. You look bad on paper, but you really made all this money. New school way of thinking is you use depreciation, which brings you down, but depreciation is added back in to your income, and it's added back to you. So we can make a lot of money here. You can be great at being a doctor. You guys are great at what you do. Keep that up, and now use the depreciation to obviously lower your taxes, as well as show taxes, pay taxes. And now you can get loans, you can buy houses, you can do more. Obviously, I use the same strategy myself, and that's how I just qualified for a $6 million property. I didn't qualify because I showed really bad taxes, obviously. So we use depreciation, and we can give that to our investors. Does it make sense? It's a little complicated at first, but cost segregation is a game changer in this business. We can do 80% of this property. So you buy $1 million property, generally you get 25% in cost segregation. So $1 million property, you can get about $250,000 in depreciation. $2 million property, you get about $500,000 in depreciation, and that can be applied to your taxes or not applied. You choose if you want to use it, or it carries 100% every year. So if you don't use it year one, you can use it year 2, year 3, year 4. So depreciation is carried over 100%, which is kind of important. 100% of it is carried over. Business income losses, it's not 100%, but I love taxes. So we've been using the same strategy because we make a lot of money flipping. That's what we're good at. And we use these rental properties for tax savings. So, I paid no federal taxes legally through cost segregation through these studies. State taxes is a little different. State by state, it's different. Every state's got its own tax code. Here in Hawaii, you will pay some state taxes, but that's a lower one. So it's not as big as that 37% tax bracket for federal taxes. You follow me? So instead of paying 37% in taxes to that income, wipe you down to 0 if you want to do it right. And we don't do this. We have an accountant, Larry, who will do this all. And I brought him on a few of these Zoom calls as well. And he talks about how we structure it up, but he'll do the whole K1s, and he'll work with you. And a bunch of my investors choose to have him do your taxes as well, but that's up to you. Cost segregation is actually not a common thing here in Hawaii. A lot of tax accountants here don't even know what it is. So a second I'm ever talking to an accountant and they ask, what's a cost segregation? Probably not the account for me, or the second I got to explain taxes to an accountant, I want to be with the guy who knows more than me. And that's what we work with Larry. I work with Matt from True Books before, Ryan Panetta's guy. I work for some real estate professional taxes, and some accountants, they do real estate taxes, but they're just not staying up with the code. This is a fairly new tax code, 2017. The old school guys are not staying up sometimes with it. So I want to work with an accountant that knows more than me. So my guy I work with, he's just drilling me on all of this stuff. Little things, little nuances. So we can do this tax savings, we can give you this depreciation, but it's per person basis. Can you use it or not? Do you qualify as a real estate professional? And if you don't qualify as a real estate professional, you can only use 25,000 a year, which is not bad. You get 25,000 in tax credits. You can then use the next 25 if you have more, 25,000 next year and next year and next year, say 4 years. Say I gave you 100 grand back, you can only use 25,000 a year per household income per your whole family, which is great. At least you're getting 25,000 in tax savings. But this is more for the high income earners and the people who have a lot of money. It's a great problem to have, but you don't want to pay. You don't want to pay all your taxes to Uncle Sam. But depreciation is a game changer. You hear a lot of people talk about cost segregation studies and all this, and it's a huge tax savings. We're great at finding the deals. We're great at flipping. We're great at finding these types of assets. So you let us be great at that. You're being great at making your money. Doctors, lawyers, agents. You're great at that, and let you be great at that, and then let's work together on cost segregation stuff. Let the accountants do that. Does that make sense? Did I explain it well? What do you think, Kylan? I leave anything out? I know you heard me
I
talking
learned a
about.
lot. I like it. No, I even picked up some more. So you did good.
Yeah. So yeah, it's just
Hey, Indra.
yeah.
I
Hey,
just had a
Alan.
question. This is
Yeah.
Hey. So if I understand, sorry, I'm a little new to this whole
No,
type of
I'm sorry. I
investment
meant to
stuff.
call you actually before this too.
Oh, it's okay. Yeah, maybe we can chat after. Yeah. So if I understand this correctly, this is it would be a 1% ownership in a
Mhm.
separate deal, and then that would allow us to have the depreciation that would wipe across all
Yes.
types of, so even active, passive, and
Mhm.
I guess if, yeah, like W-2 income or,
Yeah.
any type of active income. So
Yeah.
that wipes across all of it. Okay, cool. And that's a
Exactly.
dollar for dollar. Oh, go ahead.
Yeah, exactly. So this particular deal, actually, we wouldn't give you ownership in this particular deal because we're selling this deal.
Oh, okay.
If we sell the deal, we got to recapture, we got to pay back all that depreciation that we gained. So we don't want to do a cost seg on this particular deal because we're selling them.
Makes sense.
So we'll use with maybe the shopping center. We bought 114 houses. We have other depreciation that we can basically give back. So as long as you're fine with getting ownership of course we keep our notes and deeds and everything attached to this property, but we'll give you ownership on another property and say you own it and everything. Give you a 1% ownership. So when you own it, just like you own your car, you're able to get the depreciation back. So that's important that we give you the ownership of it.
Okay.
And our accountant takes care of all of that kind of paperwork stuff.
Okay. Yeah, thanks. That makes sense. I guess the
Yep.
other part is, if
So
it is the 1% ownership, does that mean, I guess in terms of like gains or anything else, that whole 1%, or
no,
is that
we
solely
take
for depreciation,
we take that
just
all,
structured in that way?
yeah, we take that all out. So whenever we buy a
Gotcha.
property, we start from the beginning. Whenever we buy a property, we buy it in its own LLC. For example, this one we're going to name it the address. We're going to buy this property in its own LLC. It's got its own bank account, its own entity. When you have an entity, it's got your EIN number, tax ID number. It's got an articles of or corporation, and it's got an operating agreement. And that operating agreement is where we define your roles.
Okay.
We define, you can say anything in operating agreement. You define everything in that. So in that operating agreement is how we define, just the tax savings. And we'll actually, in that operating, we'll actually say exactly how much depreciation you'll get back. So we define it in the operating agreements. And the operating agreements actually can always be amended and changed and so forth. So we can add investors on and stuff like that if we haven't done that. tax
Yeah.
segregation. So we actually have 14 companies. It's pretty easy nowadays to start a company. I can get a company started within an hour. So we'll start a company, we'll do an operating agreement, and actually the accountant's actually handling all that. He's doing the operating agreement, he's doing all that. So he'll do all that for us. He's done it now for us a bunch, so pretty easy for him. He's great.
Yeah.
His name's Larry.
Cool.
So yeah, so he'll
Yeah.
do the ownership structure in there.
Oh, that makes a lot of sense. Okay, cool. So it's all defined in the operating agreement,
Mhm,
and then
mhm.
nice. All right. Yeah, thanks for that.
So that's how we're all owning the property and getting the depreciation back. And the biggest concern is if we sell the property, you don't want to pay recapture fees or anything like that. So we take that out of there as well, so you guys don't ever get it with recapture fees or anything like that. Because if you take the depreciation now and you generally sell it within 5 years, kind of want to hold for at least 5 years, you would have to pay a recapture, because we're, instead of taking all that depreciation in 27 years, we're taking year 1. So if you sell it year 2 or 3, you have to pay a recapture, meaning that you only can take that 1 year, 2 years that you've held the property. So you have to give back some of that depreciation. So we want to only do it with assets that we're going to own for at least 5 years. Generally 5 years is where most of the depreciation is accumulated. So we'll pick an asset that we're going to hold, and we can do our depreciation studies on that asset. Some of the, I didn't get into the requirements, but the requirements are, it's got to be over 100,000 to do a cost seg study. So you can actually do it on houses. You got to do real estate full time. You got to be 750 hours a year to do real estate. You got to not be selling property. It's got to be a rental property. So it's got to be a rental property. Can't be your primary. Those are the kind of big 3 requirements for the cost seg. But sorry, do you have another question you're going to say?
Oh, no, this is good. Yeah, this is really good. Yeah, thanks.
So that's why we're great at finding these properties.
Hey, Indar, I have a question. This is Tony.
Hey, yeah. How you
What's up,
doing?
man? I'm good.
How's it going? We're filling that pool up. Tony's selling our pool house, we call it, on the water over there, 3.2 million. So
Yeah, got a showing in about 30 minutes. Hour and 30 minutes. So I think I understand how you're doing the cost segregation, but I think it wasn't that clear. Are you saying that you would allow people to invest in this multifamily and then take some cost segregation depreciation on another investment?
Yes. Yeah.
So kind of like double dipping. We're getting some return. I guess our return on this one would be decreased, and then you would give us some depreciation on another deal.
Other stuff. Yeah.
Right.
Yeah.
Okay.
I don't generally do that on flips or anything, but this larger asset we will. And we've done it for our Janesville property and our other big properties. We've done this type of structure. So we don't offer this too much. It's more better for larger type of deals. So yeah, we'll use an LLC. We'll probably use our Connecticut LLC or Janesville LLC, and you'll just be a 1% owner on we'll say Janesville LLC. I'll talk to Larry and see which one, but we'll do a 1% owner in Janesville LLC. That study, cost segregation, will be getting done. We don't have to do it until next year, and then we'll apply it for this year's taxes. So it'll be for this year's taxes too, by the way. So anything you guys are making for 2023 taxes, that's a other thing I didn't say, but it's for this year's taxes. But you don't have to use it all this year. You can actually depreciation, you can keep pushing it and saving it for next year and next year.
I want to make sure I understand how the math works. So it would be, let's say, put 100,000 into this project, you get $100,000 depreciation on the other project. So you're saving your 37% or whatever, 40%. So let's say your 100,000 actually only costs you 60,000 net of your tax savings.
Yep.
The idea is to recoup the 100,000 when this property sells. Do you also participate in the gain on this property?
Oh, I get the gain. You're just getting a preferred rate. So we'll do.
You're just getting the 12%. or less maybe.
we lowered 8 to 10%. Yeah, we'll lower that
Okay,
down.
well, let's say 8%.
Yeah, we
So
normally
basically, so let's say the deal takes 2 years. Does that sound right?
worst case, sure.
Okay,
Yeah.
let's say 2 years. So you make 8, so 16% on your 100,000, and you make, you're saving your 37%
37%.
on that, and then but you get your, do you get your nut back? Do you get your
Yep.
nut 100,000 back?
Of course, of course.
So
Yep.
you're
Plus the
okay.
16% plus the return.
Right, plus
plus the tax,
16% plus 37% that you
plus
saved on
37%.
taxes. So is that 53%?
That's the huge part.
Is
A
that
lot
where
of
I'm at?
people, yeah, exactly. That's the huge
Yeah,
part. A lot of people don't realize that
right.
it's a lot more than just that return, that
So
tax
you,
rate.
yeah, okay.
Mhm.
And maybe I just want to talk it out so people understand that are on the call.
Yeah.
You're making
No.
53% on your money in potentially 2 to 3 years.
Yeah, exactly.
Okay,
That's
I
huge.
that's amazing.
Yeah.
That's wild.
Yeah, the tax savings part of it
Yeah.
is what puts it to the next level for sure.
Yeah, and then you still, even though you have 1% of another LLC, you still have, I believe you said, part of a mortgage or a promissory note or
Yeah.
both on
On
this
this
property.
property. Yeah.
Yeah.
So
Okay.
yeah, you're protected. Your money's protected by that property, and then the tax gain is
Okay.
just some added benefit that we throw on there. And you're not gonna. We're just large enough that we get these huge tax savings. I wish I made. I think we're gonna get like 3 or 4 million this year in depreciation. I wish I made 4 million, but I don't yet. So we were able to give that back off to investors. It just I think it's a win-win for everybody. And I continue to buy properties every year just for that tax savings. Yeah. But you explain it perfectly. It's the huge savings is adding that tax savings on top of your return. Yeah. And then like you're just saying, like compared to spending $100,000, you don't get that back. If you lower your expenses down by 100,000,
Right.
you don't get it back if you spend it. Here
Yeah.
you're getting, you're getting the return on your money, plus you get the money back on the sale of the property, which is another.
And I think if I understand you, the worst case scenario is that you hold the property and rent it out until you can sell it.
Yeah, refinance it at that point if I had to.
Or
Yeah,
refinance it.
Yeah.
Oh, at that point you'd refinance it and maybe buy some of the investors out, or maybe not.
Yeah, if I can refinance and pay out all the investors, then I would.
It'd save you the 8%.
Yeah, and
Yeah.
I want to refinance or I want to sell it as quickly as I possibly can because I'm paying such high returns. Like I don't want to hold this, paying 12% and hard money's at 10%. Like I don't want to hold that. So I'm trying to be quick as I possibly can.
So if hard money is at 10%, why would you want to pay anybody 12%?
Hard money won't fund most of the deal. I get hard money 8 to 10%. They will only fund 70-ish%,
That's
70,
right.
75.
That's right. They don't
So
fund the entire deal.
There's
That's
holding
right.
cost. The holding cost is huge on this thing, and paying them. The mortgage is going to be 30, 20 grand a month mortgage, so.
Has anybody ever lost money with you? Like, certainly some people would have lost
No
money.
matter what, if I've lost on 3 deals, no matter what, those investors get paid. We have other deals. We're not gonna.
You take the loss. You've
I
taken
take
the
the loss.
loss.
Well, it comes out of our construction budget or my profits
Okay.
or some of the in-house
Yeah.
cost where I just eat it. So it's money that we spent on top of everything. I just won't recoup.
I
It's
see.
money I've spent on rehab or something. I'll lose on my rehab basically. But
I think for me, the tax savings is probably the most interesting part.
Yeah.
If I just got my money back and saved 37% on my taxes, and you just, even if I didn't get the 8% return, I get 35 or so.
I got probably 4 to 5 different real estate big agents with me. I can't share their names, but you know them very well, and they're investing with us for the same benefit because they're like you. They have a big team and they make a lot of money in their teams, and they enjoy it as well. And we actually just gave them their K1s for last year, so they got their K1s, and they take their K1s, and then they can either have your accountant do your taxes, or I can refer you to Larry to help you. So or Larry can talk to their accountant to explain how to do a cost seg study here. Some of the local Hawaii tax guys don't. It's kind of weird about to say, but they don't understand it. And I mean, it's just I guess a newer code, maybe, I'm not sure. But it's not a Hawaii tax. So the depreciation is only that straight lined one. They don't use whole accelerated. Maybe that's why Hawaii accountants don't understand it, or there's only a few that do. And I haven't figured out. But yeah, you get a K1. So if you guys anyone owned a rental properties, normally you get a K1 on your rentals, and that K1 is how you apply it to your personal taxes or any taxes. And Tony, you're obviously qualify. But
Yes, I just had a follow up again. Yeah, thanks, Tony. That was really good and helping clarify a lot of the things. So I appreciate that. So I know you mentioned it's really key to have to be a real estate professional, but also if you're not, then you're able to claim up to 25K. I guess I was under the assumption that it would only wipe out passive income. So
it wipes out all your passive income and then 25K on your W-2 non-passive income. So Tony, he's easy. He's a agent. He's a professional real estate. For a doctor, use a doctor example. If the doctor makes that money, the doctor can wipe out his passive income. Say he's got rentals, he's got any kind of passive income. He's an investor in syndicates or whatever kind of passive income. So he can wipe out all of that passive income, 100% of that, and then only 25,000 on his W-2 income.
Okay. Even if we're considered passive investors in this, I guess, 1% ownership.
Yes. So it's a fine line. There's a gray line, and that's what we're talking about here. So the gray line is that the IRS, you can do it, you can do any of this. If the IRS ever audits you, they're going to want to see that you've done real estate 750 hours a year. And it's great if you have a retired wife or something, she can manage your rentals, or you own your own rental properties, you can say. But when you have a W-2 income, you have a job, and you're doing that full time, it's hard to tell the IRS that, hey, I also am full time at real estate. Like that W-2 income kind of clashes.
Yeah.
I just don't want you guys see. There's that gray line, and I don't want to go to the wrong side of the gray line.
Gotcha. But the real estate professional, I thought it would allow you unlimited losses. Is that right?
Yeah, if you're a real estate professional.
25.
Yeah. My partner Jay, I shouldn't use his name, but he used a cost seg, and he showed a lot. He owns his own company. He controls his salary. So he showed a huge salary, and his whole salary got wiped out, and he was able to get back all his federal and state taxes. So he got back about $90,000 by using a cost seg to give back your federal and state taxes. Now we're getting into even more, but the 25,000 that you're applying to your W-2, you're getting back your state and federal taxes as well. You'll get that back out.
Oh, cool. Well,
So
I just feel like I've been doing my taxes wrong for maybe the last couple of years. So
that's why I've been preaching this stuff for years, because
you can refile, you can go back and
you can
amend those taxes.
Yeah, you can. And
I just have a lot of losses that carry over. So yeah, cool.
Yeah, so instead of showing a loss, now you use the depreciation as a loss, but depreciation is added in. Expenses are cost money. Depreciation is just a paper loss. So that's why they add it back in. Deterioration of I don't have a house, but deterioration is just added back in. So that's a huge benefit when you're trying to plan a year or two out, when you're trying to get a loan or something. You don't want to show losses, and you can't qualify for a car or something. That's another huge bonus that I enjoy. You're not showing that loss anymore. And that's actually why I
Thank
don't
you.
even do 1031s. I don't do a 1031 exchange. You want to get into it more. So 1031 exchanges are deferring taxes. So we buy a house and we sell it, and you're deferring taxes to that next house. I'm saying, hey, let's show that income this year and we'll wipe it out with this cost seg. So instead of deferring year after year after year, you know, if I didn't have enough cost seg, then I would defer it. But it's if you're in the business of buying
Yeah, makes sense.
houses constantly, rentals constantly, you know, it's a great, you know, so I'll buy one big shopping center, one big project a year just for essentially for that as well. Of course, cash flow and all that other stuff, but yeah, but the biggest benefit is one, you're getting the money back. Two, you're wiping off. The 37% is anyone over 250,000, I think. 250,000. Any income over that, if you show more than I think it's 250, you're paying the 37% taxes, federal taxes. So we're talking about your federal taxes of 37%.
Wish I can get up there, but yeah, one day.
You can, you're
Thanks.
just probably hiding it. But this is it's a great strategy that most real estate professionals, and I didn't just learn this from hanging around with small guys. I learned I'm in a circle with Brendan Turner and all these big real estate moguls, and it's like it's a regular conversation about it. And how's Tony just dived in earlier, like quickly like that when somebody catches on quickly, they understand that side of it all. That's the huge like aha moment, like the light bulb. And that was my light bulb for me personally when I was in, you know, the circle with these big guys. They're making a ton of money, and they obviously need these kinds of tax savings. This is how Donald Trump doesn't pay taxes. This is what Trump does. Trump paid $750 in taxes. He just uses that or uses losses. But I can get you guys in touch with Larry too if you want. And Larry he's the guru. He's great at business structures and entity structures, and he's amazing. And he can go over exactly if you qualify or not, kind of thing. He's really, really a smart guy. He's my accountant. He was an auditor for IRS. He just knows the code inside and out. And I'm happy to share his information. But yeah. If not, Kylan's going to get in touch with all you guys, and I want you guys to invest on this deal. It's going to be a great deal and great turnaround. And let me know if you want the tax structure. It's a lot more work, obviously, for our side. So just let me know. We can kind of start that ball rolling. And if you like, you can even talk to Tony. Tony, you can talk to Larry. Yeah. But yeah, I think it's a no-brainer, of course, when you can save money on taxes.
Yeah, that would be good. Thanks.
You guys understand it all? Tony, what do you got? I see you thinking about it there. You're not normally talking about it.
It sounds amazing. If you have the income to write off,
yeah,
I think it.
That's why I'm saying it's great for big agents like you who have, you know, big teams and big incomes. You know, not all big escrow companies too are great for escrow agents. You know, but it's hard to explain it. You know, I can send you guys some videos on it too if you'd like, or show you some real numbers. Yeah. I know you guys have heard it and you see everyone talking about it on Instagram. It's out there. And I've told it to so many people, and it's just, it's easy to understand. But sometimes, I don't know, it's too good to be true, but it's not. But this is what all the big dogs use. So if you want to talk more, Ellen, you can talk on the side if you want. I'm happy to discuss or even put you in contact with Larry.
Yeah, after would be great. I just feel like this might be my aha moment. So yeah, it'd be good to dive into some of this stuff. And I really appreciate it.
It's even a bigger aha moment when you actually do your taxes. You're like, what? I'm getting money back.
Yeah.
Oh, it's a cool feeling, especially when you have a good year in taxes. So great for people who, and make any kind of income. But I mean, so that's 37% when you're in the higher tax bracket. Obviously, it's still a tax savings when you're even in the $100,000 tax bracket, savings as well. So I play that tax game all the time, figure out how much income I need to show for this year. I'll reverse engineer and figure out how much depreciation we got for the year. And then I'm showing that much income for the year. So I'll play the game, reverse engineering it all based upon depreciation. So say I got $1 million in profit and I want to, I'll show $1 million in depreciation. So I'll play that game, Yeah. Anyone else? But we also, if you don't need tax savings, just investing on a deal, we don't really have a minimum. Normally a minimum is like 50 grand. But we take people even low as 30 grand and we just pool it all together to make our fund for this particular project. So we'll make a fund for this project and bring all our investors together, and some get tax savings, some just want a return. You get a return, you also make great returns. So got it all.
Keep in mind, guys, you'll be hearing from me. If I don't get a hold of you the first time, I'll shoot you a text. I'll shoot you an email. Just let me know if you guys are ready to hop on this deal. If not, let me know. I don't want to bug you. Like I said, I take follow-up very seriously. So just let me know and I will, set a task for myself to call you guys whenever you're ready. So yeah, I hope to see you guys on this deal. Alan, thanks for being a part of this. I'm excited to have you on, and hopefully get some more of you guys in here, and let's bring this one home.
Thank you guys.
Thanks, Kai. Thanks,
Thank you guys. We'll email you guys. Thank you.